If I handed you $10,000 today and told you this money needs to survive the next 5 years without gambling, without guessing the next crash, how would you position it? Because 2026 is not a zero interest rate world. Cheap leverage is gone. Volatility is normal, and small mistakes compound quickly. So here is exactly how I would structure $10,000 in today's environment. Not aggressively, not defensively, but intelligently. First, I separate this money into 2 categories, stability and deployment. Most people skip this step. They treat all capital the same. That's where mistakes begin. Out of $10,000, I would immediately place $3,000 into high-quality cash equivalents, a high-yield savings account or a short-term treasury ETF. This is not about returns, it's about flexibility. Cash is not laziness. Cash is optionality. When markets drop suddenly, when fear spikes, when opportunity appears, liquidity is what allows action. Without it, you become reactive. With it, you stay strategic. Next, I evaluate debt. If I have any consumer debt above 8%, that becomes priority. Paying off a guaranteed 12% credit card interest is better than chasing uncertain 8% market returns. Eliminating high-interest debt is a risk-free return. Assuming no toxic debt exists, we move to the core structure. The foundation of this portfolio is broad exposure to productive assets. I would allocate $3,000 into a low-cost total market index fund, something diversified. No stock picking, no narrative chasing, just ownership of productive companies over time. Why? Because long-term wealth is built by owning assets that generate cash flow and grow earnings, not by predicting headlines. Now we build resilience. I would allocate $2,000 into defensive diversification. This could include gold exposure and managed futures or short-duration bonds. Gold is not a growth asset. It is monetary insurance. It performs when confidence weakens. Managed futures and trend-following strategies historically perform well in volatile, shifting environments. This layer is not about maximizing upside. It is about reducing fragility. When your portfolio is resilient, you think more clearly, and clear thinking compounds. That covers $8,000. The remaining $2,000 must serve a different purpose. $1,000 goes into what I call income reinforcement. This could be a high-quality dividend ETF, a business development company with sustainable payouts, or another income-generating vehicle with reasonable fundamentals. The purpose is not yield chasing. It is cash flow psychology. When assets generate income, even small amounts, it shifts your mindset. You stop obsessing over price movements and begin focusing on system building. The final $1,000 is strategic leverage, but not financial leverage. $500 remains in opportunistic reserve. This is separate from your $3,000 liquidity bucket. This is tactical capital. When a strong company drops irrationally, when fear disconnects price from value, you deploy selectively. The last $500 goes into capability. Financial success is not just asset allocation. It is decision quality. That could mean subscribing to a disciplined macro research service, buying foundational books on capital allocation, or building a simple net worth tracking system that forces accountability. Because here is the truth. $10,000 invested well might double over time, but better decision-making compounds for life. Let me summarize the full structure. $3,000 cash equivalents for flexibility, $3,000 broad equity index exposure, $2,000 defensive diversification, $1,000 income-generating assets, $500 tactical opportunity, reserve $500 personal capability investment. This is not aggressive. It is not conservative. It is structured, and structure is what survives uncertainty. You don't need to predict whether markets rise or fall next year. You need a system that works across multiple outcomes. If growth accelerates, your equities participate. If volatility spikes, your defensive layer stabilizes. If fear creates mispricing, your cash deploys. If conditions stagnate, your income continues. That is anti-fragility. Most people fail not because they lack capital. They fail because they lack structure, and structure creates discipline. In uncertain economic cycles, the objective is not maximizing short-term return. The objective is staying in the game long enough for compounding to work. You don't need a perfect year. You need 5 solid ones. If you can protect downside, remain liquid, and steadily deploy into productive assets, $10,000 becomes a foundation, not a gamble, and foundations scale. You don't need to predict the future. You need to survive it. Because once you stay in the game long enough, the math starts working for you. That's what $10,000 should buy you.